So you see the headlines, right? The Fed is cutting rates. And you're probably thinking, great, my mortgage is about to get way cheaper. But then, crickets, nothing happens. Today, we're going to break down that costly misunderstanding, why the Fed's big moves don't always mean lower payments for you. And this, right here, this is the million-dollar question, isn't it? It's so frustrating, especially if you're trying to buy a home. You see all this positive news about rate cuts, you get your hopes up, and then you check the actual mortgage rates, and they've barely moved. It seriously feels like you're missing a key piece of the puzzle.
Okay, let's walk through a little story here. Picture this. It's late 2024, and you see that headline you've been waiting for. The Fed is cutting rates. Naturally, you think, I'll just wait. It's only going to get better. So you do. Fast forward to the middle of 2025. The Fed has cut rates not once, not twice, but 3 separate times. You go to check mortgage rates, expecting to see them in the 4s, maybe low 5s, but nope, they're still hanging out around 6.2%, and you're just left scratching your head.
Now, if you feel like the rules of the game were suddenly switched on you, you are definitely not alone. But here's the thing. It's not that the rules changed. It's that most of us were kind of taught the wrong rules from the get-go. So let's fix that and break down how this whole thing really works.
You know, the common idea is that the Fed has this giant universal switch for the economy. When they announce a rate cut, they just flip it and poof. All borrowing, credit cards, car loans, and especially mortgages magically gets cheaper for everyone, instantly. But that mental model, well, it's just not accurate.
So let's just get right to it. It's time to bust the biggest myth in real estate. Here it is, the simple, and for a lot of people, surprising truth. The Federal Reserve does not directly control your 30-year mortgage rate, not at all.
So you might be asking, well, what does the Fed control then? They control this thing right here, the federal funds rate. And look at that definition. It's the rate banks charge each other for overnight loans. Think about that time frame for a second, a single night. Now compare that to a mortgage, which is a 30-year loan. We're talking about completely different worlds here. This rate hits your credit card interest pretty quickly, but your mortgage? It's a different beast entirely. And this slide just lays it out perfectly. On the left, you've got the Fed, in charge of that super short-term rate for overnight bank loans. But on the right, that's the one that really matters for your mortgage, the 10-year Treasury yield. And yet it isn't controlled by some committee in a boardroom, it's controlled by the global bond market. That means millions of investors all over the world making bets on the future of the economy every single day.
So let's properly introduce the real star of the show when it comes to your mortgage rate, the 10-year Treasury yield. Seriously, if you want to know where mortgage rates are actually headed, stop watching the Fed's announcements and start watching this number. This is the real driver. Which, of course, brings us to the most important question in this whole story. If the Fed was busy cutting its short-term rate, what was this all-important 10-year Treasury yield doing at the exact same time? And here's the twist in the plot. The chart shows the complete opposite of what you'd think would happen. While the Fed was cutting, the long-term 10-year yield actually went up. So why on earth would that happen? Well, because those millions of investors in the bond market were looking way down the road, and they were getting worried about things like long-term inflation and rising government debt. So they started demanding a higher interest rate to lend their money out for 10 years, and that pushed the whole yield up.
And here is the direct, unbreakable link. There's a pretty simple rule of thumb here. Mortgage rates are almost always the 10-year yield plus a little extra on top, usually about 1.7 to 2%. So you can see, if that base number, the yield, goes up, your mortgage rate has no choice but to follow it, right up there too.
But wait, there's more. That 10-year yield is just the starting point. There's another hidden force that helps build your final mortgage rate. It's what the lenders add on, something called the spread. Let's break down the math. Okay, so first we start with our base. This is that 10-year Treasury yield that the bond market pushed all the way up to 4.5%. Then, on top of that 4.5%, the bank or lender that's giving you the loan adds their own margin. You can think of this as their buffer. It covers their business costs, the risk they're taking on, and of course their profit. It's usually somewhere around 1.7%, but it can actually get wider if the economy seems shaky, which just adds another layer to this whole thing. And when you take those two numbers, that 4.5% yield, and you add the lender's 1.7% spread, you land right around 6.2%. And that right there is the hidden math. That's exactly why mortgage rates stayed stubbornly high, even while you were hearing all that news about the Fed cutting its rates. Okay, so understanding the math is one thing, but this common misunderstanding, it has a real-world cost. Let's look at the actual price you can pay for waiting and trying to time the market based on the wrong signals. It can really backfire.
Just look at the hard numbers. Let's say you waited for that better rate. Okay, the rate dropped a bit, from 7% down to 6.2%. Nice. But while you were waiting, the price of the house you wanted went up from $400,000 to $420,000. And the result? Your monthly payment is basically identical, but now you need a bigger down payment, and you just spent a year or so paying your landlord's mortgage instead of your own. You've built zero equity.
So, what do we do with all this? How can you actually use this information? Let's talk about a much smarter way to approach home buying, because now that you know this, you actually have the advantage.
Here's your new game plan. It's pretty simple. First, please stop reacting to the Fed headlines. Instead, become a student of the 10-year Treasury yield. That's your true north. Number 2, always shop your loan around to different lenders, because that spread they add on can be different. And maybe most importantly, make your decision based on today's numbers, what you can afford right now, not some guess about a hypothetical future. And never forget the golden rule of real estate. You can always refinance later if rates do drop. And all of this brings us to one of my favorite sayings in all of finance. Marry the house, date the rate. Think about it. You're finding a home you want to live in for the long haul. That's the marriage. The interest rate, that's just a temporary financial condition you can change down the line by refinancing. That's the date. So it forces you to ask the real question. Are you focused on finding the right house, or are you obsessed with timing the perfect rate? Knowing what really matters, that's how you make a smart move.